More top stock picks to share with you now, or top opportunities, I should say, because they're not all stocks, but yours is a REIT, Todd.
It is, yeah. Excel Trust, EXL is a ticker symbol. They're a retail-focused REIT that generally leases to supermarkets, big box retailers, and other select national retailers that generate steady foot traffic, either because they have stuff that people need, like supermarkets, or because they're value-oriented. So it tends to do very well in a sluggish or even recessionary environment. And the company actually delivered its fourth consecutive positive earnings surprise on February 12th. And that was driven by an increase in rents and an increase in occupancy rates. So good fundamentals here, but it's interesting because REITs in general, just the market hated them in the second half of last year. They traded like high duration bonds is what I like to say, because as interest rates rose, these high yielders sold off. But I think that's starting to change. If you take a look at the 10-year Treasury yield, since the Fed announced and actually started tapering in early January, the 10 years actually decreased, the yield on it has, and REITs have started to rebound a bit. And they're kind of the only value corner of the market at this stage. So I do like the REIT space in general, and especially ones that are beating earnings surprises like EXL did. And analysts revised their estimates after their last beat pretty much significantly higher for both 2014 and 2015, sent it to a Zacks rank of 2, which is a buy rating. And in addition to that, as a REIT, they have to pay out at least 90% of their earnings in the form of dividends to avoid paying tax on that money. So they yield 5.6%, very solid yield, traded just 13 times forward earnings, so there is some value to go along here. It could be a solid total return play here over the next 3 to 6 months.
All right, I have to get to Dave before he falls asleep. Sorry, he drones periodically. So
no, not at all.
You've got a pharmaceutical stock.
Yeah, I do. I guess that's a little bit spicier than the REIT. Ariad Pharmaceuticals, the ticker is ARIA. This is an interesting story. So it was a $20 stock, and they had a leukemia drug on the market, and the FDA made them pull it because the warning label wasn't detailed enough, basically. I mean, that's kind of a 30,000-foot view of the situation. Right. But so then, it's like coming in on Monday and the mice are all dead, right? It's $2. Right, instantly. It goes from 20 to 2. And the stock's been rebounding because the FDA came back and said, okay, you can put it back on the market, you just have to add this to the label. Boom. So you have the same market, the same drug, same company, same fundamentals, but instead of paying $20 for it, now the stock's at 8.5. So basically it's just a fire sale on ARIA. So.
But momentum still to the upside.
Oh, absolutely. If you go from 240 to 850, all of a sudden now you've got some serious momentum, and nobody traded in that gap from $20 all the way down to 2. So now you got to fill in the liquidity there. So I think the stock could fill the gap over the course of the next year.
Interesting. All right, Nina, you've got this ETF here, the Market Vectors Wide Moat ETF. What is a Wide Moat ETF?
Yeah, the ticker is MOAT, and this is based on Warren Buffett's investment philosophy.
Which is?
Warren Buffett he popularized this term called economic moat, and he said that he seeks economic castles which are unreachable with the wide moats
around them.
Yeah, wide moats around them. So basically, basically, in simple words, these are companies which have sustainable competitive advantage over their competitors in the same industry, typically large cap companies with strong cash flows. So this ETF holds 20 such companies with more than 100 million in market cap, which have wide moats and which are attractively priced. They are trading at a discount to their fair value, and fair value is calculated based on discounted cash flows here. So basically, I think this ETF has more relevance this year because in the past few months or years, when QE was the main support for the stocks and ETFs, investors totally ignored fundamentals. But when QE will be gradually withdrawn, companies like this, which have a long-term sustainable competitive advantage, they have better chances of outperforming the market. Okay. This has an expense ratio of 49 basis points, and ETF is fairly new. It was created in 2012. But the index has been around for quite some time, and it has been outperforming the broader market since its inception.
Okay, thank you for that. And Dave, welcome again. You're the newcomer to the group, and it's a pleasure having you as part of the Roundtable people to pick on.
Yeah.
Don't forget, more stock picks and stock picking strategies for your review at Zacks.com. If you're not there already, get on over and check them out. With everyone here, I'm Terry Ruffalo.